Stop, right there. Are you using your personal credit card to fund your business? If you are making one of the biggest, most common, and most dangerous mistakes a small business owner can make. It's time to draw a line in the sand. Welcome back to the channel. I'm Finance Guy. And today, we're tackling a topic that can make or break your business's financial future. The critical difference between business credit and personal credit. Understanding this isn't just about getting a better loan. It's about protecting your family, unlocking massive funding, and building a valuable asset. Let's dive in. At its core, the difference is simple. Personal credit is tied to you, the individual. It's based on your social security number, SSN, and reflects your history of managing personal debts like mortgages, car loans, and credit cards. Business credit, on the other hand, is tied to your business entity. It's based on your employer identification number, EIN, and reflects your business's ability to pay its own debts. Think of it as your business's financial reputation. This is what happens when we don't utilize credit properly. This is what we have to deal with: the cold hard facts. Notice the credit bureaus are different. While Experian and Equifax play in both fields, the business side has a major player called Dun & Bradstreet, which uses a score called Paydex. The scoring models are completely different, and that's a good thing for you. Now, let's talk about the elephant in the room, the personal guarantee. When you're a new business, lenders don't trust your business yet, so they make you sign a personal guarantee. This means if your business fails to pay, you are personally responsible. This is where the lines blur. If you default on a business loan with a personal guarantee, it will trash your personal credit score. But here's the key: when you pay on time, most business credit cards and loans do not report to your personal credit bureaus. Think about the 30% credit utilization rule we discussed in a previous video. If you put a $10,000 business expense on a personal card with a $15,000 limit, your utilization just shot up to over 66%. That single transaction could drop your personal FICO score by 50 points or more, making it harder to get a mortgage or a car loan. By building strong, separate business credit, you can get credit lines that don't show up on your personal report, keeping your personal utilization at zero and your FICO score pristine. This is the ultimate financial firewall. So, how do you start building this separate financial identity? It's a process, but it's straightforward. Separating your business and personal credit is not just an option, it's a mandatory step for any serious entrepreneur. It protects your personal assets, maximizes your personal credit score, and gives your business the ability to borrow money on its own merit. If you found this video helpful, hit that like button and subscribe for more financial strategies that will help you build wealth. And if you want the full list of vendors that offer Net 30 trade lines and report to the business credit bureaus, check out the link in the description below. Thanks for watching. Now, like, share, comment, subscribe, hit that notification bell, go to the description for free tools, and I'll see you in the next video.